A lot of funds out there have a balanced investment option. I think for you and I, we would assume balanced means 50-50.
Yeah.
It doesn't. Some of them are 80%, 90% risky. People that I've seen at 60, 65 with the biggest balances haven't always been the biggest earners. They just started in their 20s putting in an extra $30, $40, $50 a paycheck, and they just did that forever.
He was quoted like 4 times more premiums than what we could get for him outside with the same insurer.
The worst outcome is you move all your super, you lose all your insurance, and you can't get new insurance. But on the freeway, the inside lane is the fast lane, the middle lane is the stay steady lane, and the outside lane is the slow lane. You're going to the same place, but do you want to drive quickly? And I always think like you need to find your lane, design your super around it.
Hi everyone, welcome to another episode of Level Up with Priyanka Shah. So many of us are out here trying to build wealth, properties, investments, even businesses. But what we often ignore is the biggest wealth creation tool that we have, superannuation. So we are here sitting today with Jordan Vaka, a very experienced financial planner, and we do a deep dive into why is it important to look into your super, how to grow our super, what are the different types of super funds out there, and why taking control of our super early, especially in our 30s and 40s, will add so much more to our long-term wealth. So if you're serious about building your long-term financial wealth, this episode is for you. Jordan, thank you so much for joining us today.
Thank you for having me. I'm looking forward to this.
Yes, so excited to talk about this topic that is so often ignored, which is superannuation. I wanted to first start by asking you, what is the right age to look at superannuation? Because people assume and they leave it till they're very old, in their 50s or 60s. What is ideal time according to you?
That's a good question. I think I'll spin it around and say the worst time to just start looking at your super is 60. You should be looking at your super the whole way through. It is your money. It is an account of yours. If you had a bank balance that was growing all the time, you'd look at it pretty frequently. So really, most people join the workforce 16 to 18, have some passing interest in it then. Definitely through your 30s and 40s, because the fees that you're paying, the differences in returns, they compound over time. So that the earlier you get to that, the better. In your 20s, you have other priorities, so you're not going to look at your super.
Yeah.
At 30s and 40s, I would flag. Definitely by 50, you should have a good idea of how much you have in super, where it is, and how it's invested.
Okay, and so if somebody, assume most people would have an industry super account, which they would have gotten started with, what is that they should be doing if they want to start actively managing or looking into their super?
All the industry super funds will have a system online where you can work out your risk tolerance or your risk profile. It's a really big part because what that does is it tells your fund or tells you what level of risk and movement in your super can you tolerate and still be okay. Very generally, the younger you are, the higher risk your portfolio should be because you have time to ride out the bumps and it'll grow more in the long term. So bit number one is have a look to make sure that you hop on your industry fund website. There'll be some information there around risk profiling, do the assessment, work out where you should be, and then make sure your investments in your fund line up with your risk profile.
Okay, so maybe log into the account, look at the statement, and that'll be a place to start.
Yeah. And also a little bit of a trick, don't take the terminology of the fund at face value. So a lot of funds out there have a balanced investment option. I think for you and I, we would assume balanced means 50-50.
Yeah.
It doesn't. Some of them are 80%, 90% risky compared to not risky. And when I say risky, for us, that just means high growth, shares and property.
Yeah.
So just don't take it at face value. Actually, you can dig in underneath it and work out exactly how you're invested.
And does someone need to call up the super fund to find out the details about it?
You can do. A lot of the statements now are quite good. They go into a fair bit of detail.
Okay.
But if you are stuck, definitely call the super fund. Their service departments. We have our challenges on the advice side in dealing with some of the funds. But generally speaking, if you're calling up with an inquiry like that, they'll be really helpful on the phone.
Okay, sure. Thank you for sharing that. And what, say, if somebody is looking at the super fund, I have logged into Australian Super, I've got my super statement up, I've jumped into the section which is telling me about the investment, how it's invested where. It'll tell me maybe the rate of return as well as to how the percentage of growth that my money is making. Is there a benchmark that there should be?
Oh, that's a good question. Strictly speaking, your level of return should directly relate to your level of risk you're taking on. So somebody who's in, say, very, very safe portfolio, you're probably looking at somewhere between 4 to 5% a year as an average return. So that's somebody with no shares, just in money, just in cash and bonds. So it won't move. That range of 4% or so, it shouldn't go below 0, but it won't go above 6. So it's very, very safe.
Right.
At the other end of the spectrum, somebody who's fully in shares, you'd want somewhere between 7 to 9% a year, knowing that could be 15 and it could be -5. So you're broadening the range. Australian Super is a good example. I actually had a look at them the other day. We use them for a bit of benchmarking.
Sure.
And their balanced account, I think, was over the last 30 years has averaged about 8.5%. So as a benchmark, that's pretty solid.
Right. Okay. And are there any particular industry super funds that you think generally perform better than the other, or are good funds? Or
I think what's happened over time with a lot of the industry funds is they've gotten bigger. They've kind of aggregated around a standard return. So the big ones are Australian Super, ART, Australian Retirement Trust, and Aware Super.
Yep.
So those three, generally their returns are within the same ballpark. They're pretty similar.
Okay.
The distinctive factors they have are probably how they're investing and how much volatility and risk there is in the portfolio. So because they're so big, for instance, they buy shares. They buy shares on the share market. But if they put all of their money in the shares every month, they would move the market. So they're busy buying airports and things like that. So their overall returns are pretty solid, but they're not as volatile as some of the smaller ones.
Right. Okay. And apart from the return that we benchmark, are there any other things like the fees or things that we should consider when comparing the funds?
As an advisor, the first thing I look at are the fees.
Okay.
Because I'm really big on the fact that we can control the fees. The returns I can't really control.
Sure.
We can control the allocation to risk and the potential returns, but ultimately it's out of my hands. So we look at fees. Fees are number one. I used to have a kind of internal benchmark that you want your super fees to be below 1% a year. That's coming down. I think if your fees are below 0.75%, you're probably in a good position a year. If you're over that, there are definitely cheaper options out there. So fees would be number one.
Okay. And that will explicitly be shown on my statement as to what the fees are.
Kind of.
Okay.
Like with any fees, there's always a bit more to it. Within Super, there's 3 levels of fees. So there's your administration fee, there's your investment fee, and then there's your optional advisor fee.
Okay.
So not everybody's paying that. With your admin fee, particularly in the industry funds, they're generally a fixed dollar amount plus a percentage a year. So it's been a little while since I looked at this, but I think Australian Super used to be like $52 a year, when it was $78 a year, plus 0.1% or something.
Off the balance.
Off the balance.
Okay.
So you can work out your administration fee. That should be on the statement. The investment fee is charged by the internal investment option. So we'll keep picking on Australian Super, but Australian Super has a balanced fund. The balanced fund will be charging its own fee, and they tend to take that off the return.
Okay.
So if you've earned 8% on that fund, I forget the exact figure, but say 0.5%, they'll pay you 7.5%.
Right.
It can be a bit hard to see the explicit fee amount, though. You can dig around. It's in the product disclosure statement and things like that. But the return that's quoted on the document will be net of fees generally.
Okay, right.
Yeah.
So the admin fee and the management or
The investment fee.
investment fee is more visible than the return fee.
Oh, sorry, yeah. So the administration fee, that's visible. The investment fee, which is the one charged out of the fund, is less visible.
Right.
Yeah, generally. You need to go looking for that normally.
Sure. And that's where someone like yourself as a financial planner would come in and help us understand what exactly is going on, what the fees are.
Yeah, it's a big part of what we do. And there's a lot of thinking around. There are other fees as well, that, trustee fees and, different administration fees. But yeah, at the end of it, we give us a summary statement and we say, look, here's how much you've paid in fees this year.
Sure.
Yeah. And also if you're paying us for a fee, like here's what that turns out to be. Yeah, I think I spend a lot of time talking about super fees because it is important, because I think every 0.5% you're paying in excess fees, when you do the compounding calculation, that's a material amount off your super at the end.
Yes.
Yeah, so it's really important.
As a financial planner, when you come in, what is exactly that you would help with to kind of understand what the super does, and then what do we do from there?
There's 2 levels. So the first one, it's kind of a product level and a strategic level. So if we're just looking at the product and just trying to compare it, bring it in, give us your statement, we'll speak to your fund, we'll get the information we need, and we'll compare it with 3 others. We compare it with 2 industry funds and 1 retail fund. We compare our fees, insurances, and service. Because the service component, most people might call their super fund every day, but when you do call them, you don't want to be on hold for 3 hours.
Sure.
Which is quick. And then we can just do a straight product review and give a recommendation around which is the best option. We'll talk about rollovers and consolidation in a second.
Yeah.
That's not black and white, but that's what we do. On the strategic side, it's a matter of you're here now at 35, you're earning this much money, you have this much in super. If all this holds true and we allow for certain assumptions, here's how much money we expect you to have at 60, 65, and 70. Does that align with what you need your super to be at those ages to achieve the life you want to achieve? So it's a much bigger discussion.
Yes.
And that's where we come back with, okay, you're going to fall short, start contributing a bit more money, or do this or do that. So that gives us the context. But the straight product comparison is relatively straightforward.
Sure. Coming to the product comparison, when you said that there's 2 industry funds and 1 retail fund, industry funds are generally like the funds available like Australian Super, Host Plus, Aware Super. Can you give us a bit more context of retail funds?
Sure. Yeah. So the industry funds traditionally are linked to occupations. So Aware Super, Hester there from the healthcare side, things like that. The retail funds are they're for-profit businesses. So they're trying to build up a book of business to generate a profit, but they're also very competitive. They're much more innovative historically. So they have much better online portals and much better investment options.
Okay.
So I won't name the fund because I won't get this number right, but some of the big industry funds have like maybe 16 different investment options.
Right.
One of the ones we use, the retail one, has about 700. Now, how valuable that is depends on you as an investor. Do you want a lot of control to build a bespoke portfolio?
Yep.
Fantastic. This is the way to go. Online access. So they're generally, in my experience, better quality products.
Sure.
But they have traditionally been dearer. That gap has closed a lot, but they're generally a little bit more expensive. So if you're talking about companies like your Macquarie's, your Netwealths, Hub24s, Colonials, those kind of funds.
Sure.
And for listeners, AMP is probably going to be a common one in their book.
Yeah. So when we do the comparison, if you say that they're more expensive than the industry funds, why would somebody pick that? Like, is the expectation that somebody will have to log in every week to see what's happening and they're going to see better returns, or what is it?
So the first thing I'd say is moving from a cheaper fund to a dearer fund, there has to be a very good reason to do so.
Yeah.
And that's internally, we have a very high bar to justify a kind of shift. And it needs to be, we spend a lot of time talking to people. What are your priorities around money and investment? So if you're somebody who, for instance, it's really important that you have an ethically aligned portfolio. So you want a portfolio that doesn't have any mining stocks or armaments or anything like that. That is easier to design the portfolio like that through a retail fund.
Sure.
Industry ones have those options, but they're kind of grey. So that's one way. Another way is if you want more control, if you want to be in there trading and moving investments around a lot easier, retail's the way to go.
Yep.
So it's very much trying to find a solution that's a bit of a horses for courses fix.
Sure.
Yeah. But there needs to be a high bar. The other thing to be conscious of, and as you know, is the insurance.
Yes, absolutely. I think when you move to a retail fund, you won't have insurance, so you'll have to set it up separately versus the industry fund, who provide insurance, but a very basic level of quality of cover and the product as well.
Yeah, and I think, I'll stand corrected, but I think it's fair to say the industry covers generally is better than nothing and not much more than that. Is that probably fair to say?
Yeah, absolutely. I think it's all right to have something when you're starting off. Like, you've just started working. It's great that the industry fund has taken that obligation and given us something. But then as we grow along the journey of life and we start building wealth, building a family, it's important, and the onus is on us to look at it and make sure that it is reflecting what our life really stands at.
Absolutely. Yeah.
So, yeah. Sure. And again, just circling back on the retail funds, is because that's a big discussion when somebody, so say if somebody's in that stage where they're building wealth, growing wealth through properties, investments, and doing all that, have a superannuation balance of say over 100,000 with their industry super fund, and you could assume that they're in the stage of growth where maybe their risk appetite is also high because they want to grow everything. What would you say to a person like that when they come to you? Would they be better off staying with their industry fund in a growth uh, portfolio in there, or consider a retail fund?
To be completely honest and possibly to betray advisors a little bit, I think industry funds are a really solid option now. And I would be encouraging people to stay there if they don't want to be looking at their super all the time. If they don't really care about their super, like you have 37 other priorities in your life.
Yep.
Number 38 is super. Think a lot about leaving it in the industry fund, particularly for retail funds going to be dearer. In saying that, though, as you get over 100,000, 200, 300,000, I think it is worth thinking a bit more about your super. And in my experience, a retail option gives you that little bit more control, that little bit more transparency, a little bit more clarity over what your super is doing.
Sure.
But for me, industry retail, they're great. The bigger thing is making sure it's aligned with your risk profile, making sure it's at a relatively low cost, making sure it's performing well. And when we talk about the strategic side of where you want to go, we can work out to some pretty solid, confidence what percentage return you need to get to the life you want to do. That's more important to me. So when we're looking at it, the product selection itself is important, but that strategic pitch is the most important piece.
Right, sure. Is return on investment ever a consideration in doing that? Are we going to say that the retail funds are going to perform better, give us better returns, or that may not? Again, nobody can predict anything, but what's generally the case?
Yeah, I think because of retail, like say that retail fund that has 600 or 700 options, potentially there's something like 21,000 different combinations you could be creating of a portfolio there. So if we say there's 21,000 options, a very solid percentage of that will outperform an industry fund.
Sure.
I don't know which of those combinations, though, to use or to lock into because we can't predict the future.
Yes.
So I think with more work, more focus, and more concentration on it, you could find a portfolio that will outperform.
Sure.
But again, if you're not super interested in your super, you're looking to just float along and just let be what it'll be. Industry is the lowest effort option.
Sure.
Could be usually. But again, if 8.5% is going to be enough to achieve the life you want to achieve, fantastic. But if you need 10%, then you're probably going to have to work out a way to carve out the difference.
Right.
Yeah.
So the long-term view and the strategic decision-making is very important, and that's where you come in and just help map out where this is going.
I have people ask me all the time, what's a good return for super? Well, how long's a piece of string? Because if you're somebody it's so unique for each person. If you're somebody who's 70 and you're very nervous about money and you have enough money to live, honestly, 3% is a good return.
Yep.
Because there's no risk. If you're 34 years old and you need $1.8 million by the time you turn 60, then really you should be chasing 8-9%.
Yeah.
So that's a good return. But they're two different people, two different returns, two different versions of good. So
yes.
That's always a hard question.
Absolutely. And so many moving parts, right? Because where you want to get to be and where you are at, and so many things could be different for everyone.
Yeah.
So
I was thinking, I don't know if this is a thing or if it's just me, but on the freeway, when you're driving down a freeway, I always picture like the inside lane is the fast lane, the middle lane is the stay steady lane, and the outside lane is the slow lane. Which lane are you most comfortable in? Like you're going to the same place, but do you want to drive quickly? And I always think like you need to find your lane, design your super around it, and make sure that it serves your purposes.
Sure. Okay, I think this is a common problem that I encounter is people having multiple super funds, which they may not be aware of. They don't know, even they know it, but they've not bothered putting it all in one. Is it important to do it, and why?
It is for a few reasons. Firstly, it simplifies just the bandwidth you have to dedicate to your super. Like you don't have to think about 5 different funds. You're not getting 5 different statements. This is messy. It's better to have it in one account. With one huge proviso, and I think you know where I'm going with this is, if you're going to consolidate the funds, be sure you're not losing anything, especially insurances that you can't replace.
Sure.
So when we're recommending consolidation, one of the big checks we do is we say, okay, you have 5 funds, you have insurance in these 3. Could you get better insurance as it is?
Yeah.
Mostly, well, chat with you and you'll say, yes, they can get better insurance, so we'll do that. Get the new insurance, get it in place, then move your superannuation.
Yeah.
Because the worst outcome is You move all in your super, you lose all your insurance, and you can't get new insurance.
Yes.
That's a horrible outcome.
Absolutely.
Yeah. So that's the biggest risk, I think, with consolidation. But generally, you are better off having one fund. It's often cheaper. I mean, yeah, often cheaper.
Yeah. And it's ease of management as well, because you've got one single account to manage rather than multiple accounts. So, no, absolutely. And I think insurance is a very good reminder that most people assume that they're okay, they've got something, but important, whenever you're doing any changes, anything that you're looking into your super, make sure you look at insurance, and also be aware that whatever is in your superannuation may not be the best insurance. So, again, we've got that mutual client that we've worked with, and the example that he was quoted like 4 times more premiums than what we could get for him outside with the same insurer. So that was an eye-opener.
I was blown away when you told me that. I was blown away, but then when I thought about it, I wasn't super surprised, because that group cover in super, it's not always cheaper, and it's certainly not better.
Exactly. And it's more expensive, it's inferior, and we're not winning with that. If we can get anything better, it's always the way to go.
I think for people that are under 50, and I mean, correct me if you think different, but I feel like superannuation, it's got, under the law, superannuation has one purpose. It's to provide retirement benefits. But if you actually read the Act, there's a secondary purpose, which is, unless the person's died, then they provide for the family. So it means that superannuation, for me under the age of 50, a big part of it is insurance funding.
Yes.
And you need to be careful about, eroding balances and stuff like that. But insurance is such a key part of super, and I never see it talked about when people are discussing super funds. So it's just something definitely to flag.
Sure. Just thinking again, self-managed super fund is one avenue that's growing very much. I see people very actively thinking about it, considering it, moving into it. Any thoughts on that?
I'm a little bit of a skeptic around SMSFs. I think for the right people, they're fantastic. Definitely 100%. I think for the wrong people, though, they can be disastrous. And if you are considering it, I think you need to be really clear on your intentions around it. And again, that's strategic picture. So is this going to get you closer to the life you wanted to live? To know that, you need to define the kind of life you want to live. And not just financially, but also, is it important to you to have control over the assets in your super? So we talked about kind of industry funds, the set and forget, leave it alone. Retail fund, you have some control over blending portfolios. Self-managed super fund, you have nitty-gritty, minute control over the investments. If that's important to you, wonderful. That's the way to go. If it's not, it can maybe be wrong. I think it can be expensive, so you need to be very conscious of that. But I think if you go into it eyes wide open, it serves your purposes, and it's going to help you achieve the life you want to live, then fantastic. Part of my skepticism, and I should flag, because I think it's in the mainstream news enough that your listeners will be familiar with it, is there's been some scandals lately.
Right.
Shield and First Guardian in particular, where some nefarious actors were funneling people into self-managed super funds and then doing bad things with the money. So that's fed into my skepticism a little bit, because we're seeing some of the victims come through. But I think it's a very valid option for the right people. And if you're looking at it, I think just be really thorough in your due diligence. It can work.
Sure, no, that's fair. And again, I see people just doing it for the sake that, I've got a friend who's doing it, I've got someone. And again, that's not the right reason to consider that, guys. So if you're doing it, consult a professional, make sure you're doing it for the right reasons, in the right way, and investing it correctly. It's your long-term retirement money. You don't want it to be wasted around. So
yeah, 100%. I think it's just all these money discussions and decisions. Do not listen to what your friends are doing. Bless them, but their lives are different than ours.
I know.
Just be really intentional about your own choices.
Absolutely. If someone's listening to this episode and they have to take one action in relation to their super, what should that be?
Set up your online account. Just about every super fund now will have the ability to set up an online account, so you can log in down the phone. A lot of them have apps. Set that up. Get that all set up for you.
Yeah, be on top of it. Yeah. Good advice. Yeah. What is one thing that every 40 or 50-year-old should understand about their superannuation, and which they think they should have done 20 years ago?
Oh, okay. Know where it is, know how it's invested, and know how that compares with your own risk profile and requirements. So know your product well and know your strategic picture well, and make sure the two of them are aligned.
Yeah, and if you don't know, you know who to speak with.
Absolutely. More happy to help anybody. Also, a lot of the big funds now have quite good call centers. They have good websites. They have good, I always struggle with this word, trajectory analysis on their website. So you can sort of plug in your numbers and it'll tell you the path you're on. So just engage with your super.
Perfect. Awesome. And if somebody is looking to grow their long-term wealth through superannuation, what is one piece of advice that you could give them for free right now?
Start young, start putting in a small amount of money. The people that I've seen at 60, 65 with the biggest balances haven't always been the biggest earners. They just started in their 20s putting in an extra $30, $40, $50 a paycheck into their super as a salary sacrifice. And they just did that forever. They did that with bonuses and with pay rises, and just over time it just grew. But just a small amount started early enough can move mountains.
Awesome. Perfect. That's amazing. Thank you so much for sharing that, Jordan. That was valuable.
Thank you, Priyanka. Thank you for having me. Yeah, it was a great time.
Thank you.